If you own OCBC shares, or are thinking of buying them for the dividends, stop scrolling. This is the only video you need to watch today. We're breaking down OCBC Bank's first half 2025 earnings announced on the 1st August 2025, and whether that sweet 5% dividend is still safe. We'll look at the real reason profits are down, whether OCBC is overvalued, and how the Fed's next interest rate move could change everything. So make sure to watch till the end. It could save or even make you thousands in the long run. Like this video so more Singaporeans can discover dividend investing, and subscribe to Wealth for You, where we help you build monthly kopi money, one stock at a time. Disclaimer: this video is for educational and entertainment purposes only. It's not financial advice, so please do your own research or consult a licensed advisor before making investment decisions. Chapter 1. What is dividend investing and why should you care? First, quick refresher. Dividend investing is all about earning regular income from stocks, not just hoping the price goes up. Think of it like this. Every time OCBC pays you a dividend, it's like getting a bonus for holding their shares. Over time, those payouts add up and compound, and that's how you grow real wealth. Not from hype, but from steady cash flow. Chapter 2. What does OCBC actually do? So, who exactly is OCBC? And why do so many dividend investors love it? Well, OCBC isn't just your average neighborhood bank. It's one of Singapore's big three financial giants. And over the years, it's become a regional powerhouse with a surprisingly diverse business model. Let me break it down. OCBC makes money from lending, like your typical home loans, car loans, and SME business financing. Wealth management, managing billions in assets under management from clients big and small. Insurance, through its major ownership of Great Eastern, which adds a nice cushion of recurring income. Treasury and trading, handling everything from corporate foreign exchange to bond sales and investments. In short, OCBC isn't just a savings account company. It's a multi-engine financial machine that keeps running, even when one part slows down. And OCBC isn't just operating in our little red dot. Here's a look at where the money's coming from. Singapore, still the core, with 53% of group profit. Malaysia contributes around 14%. Greater China, a growing segment at 20%. Indonesia and other Asia, the rest, forming a diversified base. So yes, OCBC is more than just one bank, one market. It's got multiple income streams spread across multiple countries, serving millions of customers. Diversification? Absolutely. Stability and resilience? We'll find out in the next chapter. Stay with me, because in a volatile world, business model strength matters just as much as dividend yield. Chapter 3. OCBC's 1H25 earnings breakdown. All right, now let's dive into the part many investors care about most, the numbers. Don't worry, I'll keep it simple and explain what each one actually means for us as income investors. Net profit, $3.7 billion. That's a 6% drop compared to the same period last year. Why? Mainly due to falling interest rates, which reduce the profit OCBC earns from loans. But here's the silver lining. Even though profit went down, OCBC still beat analysts' expectations. So it's not all bad news. Total income, $7.2 billion. This includes both interest income from lending and non-interest income like fees and insurance. It's down just 1%, which shows that OCBC's non-interest income is helping to cushion the blow from lower interest margins. Net interest income, down 5%. This is the money OCBC makes from borrowing at one rate and lending at a higher rate. The bank's bread and butter. So a 5% drop here means core banking is under pressure, thanks to falling interest rates and tighter margins. Net interest margin, or NIM, 1.98%. This is a key profitability metric for banks. It dropped from 2.3% last year to 1.98% now. That's a meaningful decline. Translation? OCBC is earning less for every dollar it lends out, and that's likely to continue if interest rates keep falling. Return on equity, or ROE, 12.6%. This tells us how efficiently OCBC is using shareholders' money to generate profit. 12.6% is still a solid figure, especially in a declining interest rate environment. It's not at peak levels, but definitely not alarming either. So putting it all together, OCBC's earnings for the first half of 2025 were clearly weaker than last year. But they were better than what analysts expected, and the bank is still highly profitable. Now the question is, can they maintain that dividend? Let's talk about that next. Chapter 4. What's growing? All right, so far we've seen that OCBC's core lending business took a hit from falling interest rates. But here's the good news. OCBC isn't a one-trick pony. While lending income is down, other parts of the business are doing surprisingly well. Let's take a look at the bright spots. First, wealth management fees are up by 25%. This is a big one. OCBC's wealth business, helping clients manage and grow their money, brought in 25% more fees compared to last year. Why? Because more customers are investing, markets have been strong, and OCBC has been growing its assets under management. Translation for investors. This is a fee-based business, so it's less sensitive to interest rates and can grow even in low-rate environments. Next, non-interest income is up 8%. OCBC made more money from non-lending activities like fees and commissions, wealth management, trading, and insurance. This 8% growth shows that OCBC has a healthy mix of revenue streams beyond just traditional loans. Trading income is also still strong, with OCBC's treasury and trading desk delivering solid results. Trading income is up 6%. This might surprise some, but with market volatility and higher client demand for currency hedging and fixed income products, the bank was able to boost customer flow income. Key takeaway: even during market uncertainty, OCBC's trading team is finding ways to profit. And don't forget insurance. Great Eastern pulled its weight too. OCBC's insurance arm, Great Eastern, chipped in with 5% higher profit. While new sales were down, investment income improved. A reminder that insurance can be cyclical but still profitable in the right environment. So, even though net interest income dropped, these other segments helped prop up earnings. That's diversification in action, like having multiple income streams in your own life. If one dries up, the others can still keep the lights on and the copy flowing. Chapter 5. What's dragging earnings? All right, now let's talk about the not-so-fun stuff. What's actually pulling OCBC's earnings down in the first half of 2025? First up, falling interest income. OCBC's core lending income, what they earn from giving out home loans, car loans, business loans, is down. Why? Because interest rates have been dropping, and that means banks earn less on every dollar they lend out. Next, shrinking net interest margin, or NIM. This is the key profitability measure for any bank. NIM has dropped from 2.23% last year to 1.98% now, and OCBC expects it to go even lower in the second half. It's like running a business where your selling price is falling, but your costs are staying put. Not ideal, right? Then there's the deposit dilemma. Here's the tricky part. Even though lending rates are falling, banks can't always cut deposit rates right away. If they drop fixed deposit rates too much, people might just pull their money out. So they're stuck paying higher funding costs while earning less on loans. and that squeezes profits. That's the challenge OCBC and all banks are facing right now. Lower rates might be good for borrowers, but for banks, not so much. But hey, it's not all doom and gloom. The bank's still profitable, just not growing the way it used to. Let's see what that means for dividends next. Chapter 6. OCBC's Dividend. Still worth it in 2025? Alright, let's get to the part that most of us dividend investors really care about. The dividends. For many Singaporeans, OCBC isn't just a bank. It's a reliable monthly kopi money machine. But is that still true in 2025? So, what's the dividend situation right now? OCBC declared an interim dividend of 41 cents per share for the first half of 2025. That's slightly lower than last year's 44 cents. Nothing dramatic, but it does reflect the weaker earnings. This dividend represents a 50% payout ratio, which is fairly typical for banks. And the management has guided for a full-year payout ratio of 60%, which includes share buybacks, another way of returning value to shareholders. So the message is clear. OCBC is still committed to rewarding shareholders, even if profits are under some pressure. What about the dividend yield today? At a share price of around $16.90, your dividend yield based on core dividends comes in at about 5%. That's pretty decent, especially in today's low-interest environment where fixed deposits barely scrape past 3%. But, is it sustainable? Great question. And here's where we need to read between the lines a little. Yes, the dividend looks sustainable for now. OCBC is still profitable, has strong capital ratios, and isn't overstretched. But, and it's an important but, earnings are trending lower. They've increased the payout ratio to keep the dividend attractive, and special dividends like the one paid last year are unlikely to repeat. Those came from excess capital, not recurring profits. So while the 5% yield looks solid on paper, it's not invincible. If earnings keep declining into 2026, OCBC may have to slow down dividend growth, or just hold the payout flat. Bottom line? OCBC is still a dependable dividend stock today, but we need to keep an eye on those earnings, because even the best kopi machines need good beans to keep brewing. Stick around. Next, we'll talk about what rising or falling interest rates might mean for OCBC's future profits and your passive income. Chapter 7. How does the Fed impact OCBC? Ah yes, let's talk about the Federal Reserve, or as we like to call it, the big boss of global interest rates. So far, in 2025, Fed Chair Jerome Powell hasn't cut rates yet because U.S. inflation is still a little too sticky for comfort. But here in Asia, it's a different story. Many central banks, including Singapore's, have already started easing rates. So what does this mean for OCBC? It means narrower lending margins. The gap between what OCBC earns from loans and what it pays depositors is shrinking. And if the Fed eventually slashes rates sharply in 2026, global interest rates could tumble even further, which could put even more pressure on OCBC's net interest income, the core engine of its profits. Bottom line, lower rates mean lower net interest margin, which means lower earnings, and that could mean potential pressure on dividends. It's a domino effect that dividend investors need to watch closely, because interest rates are like gravity for bank earnings. So if you're banking on OCBC for passive income, keep an eye not just on the stock price, but on what Powell and other central bankers are up to. They could affect your next dividend check more than you think. Chapter 8. Is OCBC overvalued or undervalued? So now the million-dollar question. Is OCBC still a good deal at today's price? Right now, OCBC is trading at about 1.3 times its book value. That's basically what investors are paying above its net asset value per share. Is that expensive? Not really. But is it cheap? Also, not quite. What history tells us? Historically, during economic slowdowns or recessions, Singapore banks, including OCBC, often trade at around 1 times book value or even lower. So while 1.3 times is considered a fair valuation in a stable market, it leaves limited upside unless earnings improve significantly. What this means for investors: if you're a long-term dividend investor, this isn't a bad level to hold, especially if you're in it for the cash flow, not short-term gains. But if you're looking for a true bargain or margin of safety, you might want to wait for a dip. Maybe when it's closer to $15 or below, where the yield becomes even more attractive and valuation is more compelling. So OCBC isn't overpriced, but it's not a steal either. Call it reasonably valued for peace-of-mind dividends, but not quite a buy-the-dip moment. At least, not yet. Chapter 9. Buy, hold, or avoid. Alright, let's bring it all together. If you're someone who values steady dividend income and you're not too stressed about short-term share price movements, then here's my honest take. OCBC is a hold. Why? The 5% dividend yield is still solid, especially when compared to fixed deposits or CPF interest. The business is well diversified, with income from lending, wealth management, insurance, and trading. The balance sheet is strong, with high capital ratios and stable credit quality, so OCBC isn't in financial trouble. So if you're already holding OCBC, there's no urgent reason to sell. It still plays the role of a steady defensive stock in a dividend portfolio. But here's the catch: earnings are under pressure, especially from shrinking lending margins. The Fed and global interest rates could fall further, putting even more strain on profits. And at 1.3 times book value, OCBC is not exactly cheap. It's fairly priced, maybe even a little stretched. This isn't a screaming buy unless the stock pulls back to a more attractive level, say around $15 or below, where both valuation and dividend yield would look even more compelling. So, if you're in it for the long haul and love your COPI money to flow in every half year, OCBC is a decent set and forget kind of stock. But if you're looking for big capital gains or deep value right now, you might want to hold off and wait for a better entry point. Final thoughts. At the end of the day, investing isn't about chasing the next hot stock or timing the market perfectly. It's about owning solid, dependable businesses that pay you to wait. And that's exactly what dividend investing is all about. OCBC may not be flashy. It won't double overnight. But what it does do is quietly put cash in your pocket, year after year. And if you're someone who'd rather be cash flow rich than paper rich, then OCBC might still deserve a stable spot in your dividend portfolio. If you found this video helpful, do me a favor. Tap that like button so more Singaporeans can learn about dividend investing. And don't forget to subscribe to Wealth for You, where we break down dividend stocks simply and show you how to build monthly COPI money, one investment at a time. Drop a comment below. Are you buying more OCBC, holding, or waiting for a pullback? Thanks so much for watching. Until next time, stay invested, stay rewarded. Take care.